Have you ever felt like the market is personally targeting your stop loss? You enter a trade with full confidence, and somehow price taps your stop to the exact pip and then explodes in your direction like nothing happened. It's almost as if someone is watching your trades and hunting your stops on purpose. But here's what nobody tells you. Your stop loss isn't getting hit by accident. It's liquidity. Institutions need your stops to fill their own orders, and once you understand how they hunt, you finally stop getting hunted. If you're new to liquidity, let me give you the simple version. And if you already understand liquidity, you can skip ahead to the advanced section. Liquidity in the market basically refers to orders, mainly stop losses, buy stops, and sell stops. The two types we'll focus on are the most common: equal highs, equal lows, and then ascending and descending trend lines. Retail traders are taught something very basic: sell resistance, buy support. So when price taps resistance twice, people start selling from that level. Their stop loss goes right above the high. Breakout traders also place buy stop orders above that same level. So now, above the equal highs, you have a pile of buy orders, sellers' stop losses, and breakout traders' buy stops. That creates buy-side liquidity. Now imagine you're a large institution trying to sell millions in one position. If you sell below resistance, your order size might push the market down before you're even fully filled. Instead, you wait for price to go above the highs, where all those automatic buy orders get triggered. That gives you enough liquidity to execute a massive sell. This creates the classic liquidity sweep or false breakout. Buyers get trapped, sellers get stopped out, and then the market drops. Equal lows work the exact same way. Buyers place stop losses below support, and breakout traders place sell stop orders. When price dips into that area, a huge wave of sell orders appears, perfect for a large buyer to fill their position before the market moves up. This is why buying straight from equal lows or selling straight from equal highs often ends in losses. Institutions aren't entering at the level. They're entering beyond it, where the liquidity sits. Trend lines follow the same logic. Once a trend line forms, buyers try to buy the retest, placing stop losses underneath. Breakout traders place sell stops. This again creates a liquidity pocket. And instead of giving a perfect bounce or clean retest, the market often slices through the line, sweeps both sides, and then continues in the intended direction. Descending trend lines behave the same. Liquidity forms on both sides, and the sweep comes before the real move. That's the core of liquidity. Now we can move into the more advanced ideas around inducements and how liquidity interacts with supply and demand. When we talk about liquidity, structure, and supply-demand imbalances, they all work together under price action, what many people call smart money trading. But even with all that, we still have to pay attention to the liquidity sitting around our supply and demand zones. In this example, we're looking specifically at a supply zone, a place where we expect to search for sell setups when price returns. But the key is this: when price taps into a supply zone, we must also consider the liquidity resting around it: equal highs, equal lows, and trend liquidity. Imagine price comes back into a supply area and forms something like equal highs, basically a double top. Even though this looks like a clean reaction, it's not an ideal place to sell. Those equal highs are untouched liquidity, which means the market may want to take them out first before making any real move down. If we sell early expecting price to drop, the danger is simple. Price can push up, sweep those equal highs, and only after that start the actual sell move. This is extremely common. A double top inside a supply zone doesn't mean an instant reversal. Many times, the market will grab that liquidity first, then drop, stopping out anyone who entered too early. And it doesn't end there. Most charts don't have just one supply zone. Often, there are multiple zones stacked above each other or imbalances leading into a higher zone. So even if the first supply reacts and even shows signs of weakness, the liquidity above can still pull price further upward, sometimes all the way into the next supply zone. So the problem isn't only inside the first zone, it's also in the larger context. We have to understand if there's another area above that the market may want to reach before making the meaningful move. To understand which one is the fake zone and which is the real zone, we need to use a simple entry model. You can see here, at the first zone, once the liquidity forms and is swept or collected, a change of character chalk must occur. If a change of character happens, it means buyers have failed, and the control has shifted to sellers. Therefore, we should look for a selling opportunity from a small pullback there. However, if that doesn't happen, meaning liquidity forms at the first zone, but there is no change of character, we should estimate that the price is moving up just to grab that liquidity. After taking the liquidity, if it makes a higher high but still shows no change of character, we wait. Then, at the second zone, if you see a change of character, It indicates that it has come under seller control. The structure has shifted from buying, bullish, to bearish. So, using this simple logic, we can look for a selling opportunity from there. Alright, let's take this concept into a real chart so it's easier to understand. We're on EUR/USD 15-minute time frame. And like I always say, this works on every time frame because it's pure supply and demand. Price has recently pushed upward after retesting a demand zone, creating a new high. Before we look for entries, we want to study the structure that already formed. Inside this impulsive leg, we actually have 3 demand zones. One here, another in the middle, and the extreme zone at the very bottom. The extreme zone is the last clean demand because everything above it has already been filled in. Now, based on our inducement theory, our goal is to choose the correct zone, not just buy the first demand we see. So the first zone, we skip it. There's no confirmation, and imbalance is still sitting below it. Price later sweeps that area. The second zone, same story. Price reacts, but there's no structural shift and more imbalance below. Again, price continues lower. Only when price reaches the extreme demand do we start to see the trend change. The internal structure leading into that level is bearish. High, low, lower high, lower low. The break above this high marks the first real confirmation that the trend is shifting bullish. That gives us the idea. Okay, now we can look for buys from demand. That's our bigger picture setup. But now let's refine this and look inside the smaller leg. Dropping one time frame lower, we see the same pattern repeat, bearish structure flipping bullish. And inside this smaller range, we have 2 potential demand zones again, one higher up and one deeper. Both have imbalance feeding into them. So which one should we trust? This is where inducement becomes important. Because imbalance is still sitting below the upper zone, the likeliest outcome is price sweeping that zone before making the real move. If you place a buy limit there, you might be right about direction but still get stopped out first. So we wait for confirmation. Price taps the upper demand, but does not break structure upward. No confirmation, no trade. As usual, the second zone was hit and a fractal change of character occurred, turning bullish. So it came under bullish control. This acted like an inducement at the first zone. It collected liquidity, considered the second zone as demand, and then the fractal change of character happened. Therefore, we should confidently take an entry from here. We place our stop loss below the demand zone, and our target should be placed at the next supply zone. We are taking the trade with confidence, and it will work out. You can see, since our stop loss and target are based on perfect analysis, our target was hit. This chart is extremely important. Look at the chart. What stands out first? For me, the most obvious thing is the cluster of equal lows, a clean support floor where price tapped the same level and bounced multiple times. When buyers keep buying the same support, we already know what comes next. A wall of stop losses sitting right below that floor. Sell stop orders from breakout traders waiting to short the breakdown. So underneath those equal lows, we have a perfect liquidity pool. A huge pocket of orders the market wants to react to. Here's where most beginners get caught. The next time price returns to that support level, retail traders buy it again. But smart liquidity traders wait. They know price is very likely to break the support first, sweep the stop losses below it, trigger the sell stops, and only then react strongly. So instead of buying support, we do not buy the retest. Wait for the sweep of the equal lows. Expect a reaction after liquidity is taken. Already, we're shifting from being hunted to trading with the hunter. Now look higher on the chart. We also have equal highs. Multiple touches of the same resistance level. 1, 2, 3, 4 clean retests. And then 5, 6, 7 more relative equal highs stacking liquidity above the zone. Anyone selling at that resistance? Their stop losses sit above the highs. Breakout buyers waiting to buy the breakout? Buy stops also sit above. So now we've mapped both sides of the range. Liquidity below, equal lows. Liquidity above, equal highs. A perfect liquidity playground. Watch what price does next. This is the pattern you'll see again and again. Price drops into the equal lows, sweeps the sell-side liquidity below. Massive transactions get triggered. Momentum suddenly shifts upward. That's your signal. Now we look for buying opportunities, because the market has just collected the liquidity needed to push higher. Where do we target? The equal highs. Because the buy-side liquidity sitting above is highly likely to be taken next. And just like that, price rallies upward, retests demand, and moves smoothly toward the equal highs with very little resistance in the middle, because there are very few orders mid-range. Only when price finally trades above the equal highs do we see a reaction again. Because that's where fresh orders get triggered. Equal highs and equal lows are more than support and resistance. They are magnets for price. Reversal points, target points, and liquidity triggers. Once you start mapping liquidity on both sides of the chart, you stop worrying about candle colors and start following where the orders are. Thank you so much for watching the video. Don't forget to like and subscribe.